If you're into trains, trucks and heavy haulage, you may want to get to know this business. Aurizon Holdings is listed on the Australian Stock Exchange under the ticker AZJ, and it has an enterprise value of about $10.2 billion. Its share price has increased nicely, 35% from $3.70 to $5 in the past year, and it's also paid out 25 cents in dividends. It's currently trading on a 9 times forward EBITDA multiple, which is in line with what it's been in the past, and also in line with other logistics businesses and regulated infrastructure owners. It is also trading at a small discount to the $5.20 valuation on Shareclarity. Aurizon's history dates back to 1865, when the first railway line was commissioned in Queensland, Australia. As the Industrial Revolution and demand for coal swept across the world, so too did the size of its railway network. Aurizon began to connect more and more coal mines to seaports across Australia's eastern seaboard, and in 2004 it began to offer its own national logistics services. It was privatised by the Queensland Government in 2010 and now has 2 principal business lines. It owns and operates the Central Queensland Coal Network, which connects over 30 mines to the Abbott Point, Mackay and Gladstone seaports. Its railway assets are regulated by the Queensland Competition Authority under the Building Blocks regime, which simply involves determining a fair return on its assets, adding back the capital and operating expenditure it's likely to incur, and then splitting it across the distance and weight of cargo that is expected to be transported over its network. Aurizon's below-rail network makes up 60% of its fixed asset base, but contributes around 5% of its EBITDA, the bulk of which is otherwise generated from its other business line, logistics. It owns a sizable fleet of trains and trucks that transport coal, iron ore, nickel and other cargo around the country. When I looked at the valuation on Shareclarity, I was keen to look and work through the regulated part of the business. Ordinarily this is very complex and you'd probably want a few Red Bulls before you start, but I was actually most interested in the methodology by which its assets are regulated, and in particular how the risk-free rate was calculated. One of the key things the regulator tries to do is determine an appropriate or fair investment return that the business would make if it operated in a non-monopolistic environment, and a key input to this calculation is the risk-free rate. The challenge, however, is that this is a purely theoretical model applied to the real world, and it can sometimes lead to unpractical outcomes that add unintended or not immediately obvious risks to the business. In Aurizon's case, the risk-free rate is based on the 10-year government bond yield over a 20-day period, and that's what's used to set its allowable return for a 4-year regulatory period. The difficulty is that it's not practical for Aurizon to roll over all of its fixed loans at one time, and instead it's more practical to spread the maturity of its debt profile over time. So if interest rates were to rise, Aurizon's borrowing costs would expectedly also start to rise. But its allowable return would not, and this would place an unintended squeeze on its cash flows and a risk on its business. I think I'll probably stop there, with the point being to spend some time understanding the regulatory environment when looking at this business.